You've watched 100 hours of trading content and you still can't pull money out of the market consistently. Trading isn't a knowledge game, it's a decision-making game. You can understand everything perfectly and still fail when it matters, and that's exactly what's happening to you. So let me tell you why you're stuck. You're learning in the wrong order. You're chasing 20 strategies before you've watched a single ticker long enough to understand how it actually moves. Bruce Lee said it like this: "I fear not the man who has practiced 10,000 kicks once. I fear the man who has practiced one kick 10,000 times." So this video isn't another setup for the pile. It's one moment of the trading day where the mechanics are most exploitable. A single repeatable trade that takes under 5 minutes to place, then frees you from the screen for the rest of the morning. The first 15 minutes after the open. Let's get straight to it. The opening of any liquid market is a fight for liquidity. And here's the thing, institutions have a problem most retail traders never think about. If a hedge fund wants to dump $50 million worth of Tesla on a Tuesday morning, they can't just press a button and sell. The order would crater the price before they finished filling it. They'd basically be selling to themselves. Same problem in reverse when they want to buy in size. So, they engineer a solution. They push the price aggressively in one direction in the first 15 minutes, fast and hard, and every retail trader watching the candle does the same thing. They chase it, or they get scared and slam their stop loss. Either way, a wall of orders gets triggered. And that wall of orders is exactly the liquidity the institutions needed to fill their actual position, which is usually in the opposite direction of the candle. That's the trick. The first candle is the bait. The real move comes after. So when you see a fast, decisive, aggressive candle in those first 15 minutes, whether it's pointing up or pointing down, what you're really seeing is a manipulation candle. And the smartest thing you can do is wait for it to close, then trade in the opposite direction. That's exactly where the price is heading next. That's the edge. 3 steps to actually place the trade. Let me walk you through it. First step, open TradingView. If you don't have it yet, I'll leave a link in the description. Choose any chart depending on the asset you're planning to trade. This strategy works across all markets. Next, make sure your time frame is set to 15 minutes. Go to the time zone setting in the bottom right corner of your chart and select New York time. Wait for the very first candle of the trading day to fully close. Don't trade it while it's still forming, just let it finish. Once it closes, on the left toolbar, click the second icon down. That's the Fibonacci retracement tool. Anchor it from the highest point of that candle down to the lowest. Then extend the levels out into the future. Here are the levels we'll be using: 0, 0.382, 0.5, 0.618, and 1. So open the settings and uncheck this one, this other one, this, and this. That's it for step 1. Now let me show you step 2. Confirm that the candle you just boxed in is actually a manipulation candle. Here's what you do. Switch over to the daily chart of whatever asset you're trading and add the average true range indicator. Default settings, 14 days, no adjustments needed. This gives you a number. In our example, this is the value. Now that value represents the average daily range over the past 14 days. Here's the rule. If the size of the candle you just boxed, from high to low, is 20 to 25% or more of that daily ATR, it's a confirmed manipulation candle. So take the ATR value, multiply by 20 to 25%, and you get this value. That's your threshold. In our example, the candle ranges from here to here. That's well beyond the value we calculated. Confirmed. Now, if you're looking at a candle sitting at around the 19 to 20% range, don't stress over it. You can still work with it. But 25% or higher is a dead giveaway. Now we move on to step 3. Place the perfect trade. Switch from the 15-minute chart down to the 1-minute time frame. The direction depends entirely on the color of that opening candle. If the candle was red, meaning it pushed down hard, you're going long. After a strong push down, price almost never just keeps dropping. It pulls back up into the range first, a relief move, then comes back down to retest the low. So you place a limit order to buy at the very low of the range. A limit order is a pending order. It only fires at the exact price you set. Until then, it just sits there. If the candle was green, meaning it pushed up hard, you're going short. Same dynamic, mirror image. Price pulls back down into the range first, then comes back up to retest the high. You place a limit order to sell at the very high of the range. That's the entire entry logic. Opposite direction of the manipulation candle. No second guessing, no waiting for confirmation candles. Now for the target. If you're long, your target is the 38.2% Fibonacci level, the first major retracement above the floor. If you're short, your target is the 61.8% Fibonacci level, the first major retracement below the ceiling. Either way, that's where you take profit. And the stop loss, you want a 2-to-1 risk to reward ratio. So whatever the distance is from your entry to your target, your stop loss goes at half that distance on the opposite side of the entry. If the target is 60 cents away, your stop is 30 cents away. If the target is $1, the stop is 50 cents. That math is locked in. One more rule. You only enter the trade within the first 90 minutes after the market opens. If the limit order hasn't filled by then, the setup is over. Don't chase. That's it. 3 steps. Fibonacci the range, confirm the liquidity candle with the ATR filter, place the limit order at the edge of the range with a 2-to-1 stop. The whole thing takes less than 5 minutes once you've done it twice. Why does this strategy win so much more than it loses? It's not because the entry is genius, it's not because the Fibonacci levels are magic. The actual reason is something most traders never sit down and work out, and once you see it, you can't unsee it. There are only 4 things the price can possibly do in those first 90 minutes after a liquidity candle closes. Scenario 1. The price goes up to collect strength first, then breaks through the range in the original direction. Sounds bad, right? Except it has to go up first, which means on its way up, it passes right through your target. Trade closes in profit before the breakout ever happens. Scenario 2. The price just chops sideways inside the range the whole day, bouncing between the floor and the ceiling, which means it passes through your target multiple times. Profit. Scenario 3. The price fully reverses and breaks out the other side of the range entirely. Even better, your target is in the middle, so the price has to cross it on its way out. Profit again. Scenario 4. The price breaks straight through your entry on the first touch and never comes back. That's your one losing scenario. And from the backtests, that's what happens less than 30% of the time. 3 out of 4 scenarios are wins. 1 is a loss. And because you're already running a 2-to-1 risk to reward on every trade, the math is brutal in your favor. Even if 4 out of 10 trades lose, you still come out ahead at the end of the month. Let me show you what this looks like on a live chart. But first, thank you to this incredible community. The most heartfelt comments will get a special reward. Your support is what keeps this channel alive. This week's winner is this comment right here. Please reach out to my email to claim your free month of Flux charts. Now, if you haven't heard about Flux charts yet, this is the platform I use every single day for my trades. It completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once, so instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part, 90% of their indicators are completely free. Plus, you can use Flux charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. Watch this. Market opens. The first 15-minute candle prints green, strong push up. Look at the size of it. I pull up the daily ATR on this stock. The number comes back, that value right there. I take 25% of it. That gives me this threshold here. The candle range is this much, clearly over the threshold. Confirmed manipulation candle. Fibonacci goes on the candle. High down to low. Extended across the chart. Switch to the 1-minute time frame. Because the candle is green, I'm placing a short limit order right at the high of the range. Target on the 61.8 line, right here. Stop above the high at 2-to-1 risk to reward. Now I just wait. Price is coming off the high, drifting down into the range. Now it's pushing back up. Coming up, there, touches the high. Limit order fills. Now we want the turn. And there it goes, dripping down, few red candles. Now it's chopping sideways inside the range. Could break either way here. Good, another leg lower. Halfway to the target. One more push, hit. Trade closed in profit. Now let me show you the other direction. Same strategy, opposite color. Market opens. This time the first 15-minute candle prints red. Strong push down. Look at the size of it. Same drill. I pull the daily ATR, this value right here. 25% of it, that's this threshold. The candle range is this much, over the threshold. Manipulation candle confirmed. Anchor the Fibonacci on the candle, high down to low. Extend it across the chart. Switch to the 1-minute time frame. Because the candle is red, the trade flips. Long limit order this time, placed right at the low of the range. Target on the 38.2 line, right here. Stop below the low at 2-to-1 risk to reward. Now I just wait. Price is coming off the low, drifting up into the range. Now it's pushing back down. Coming down, there, touches the low. Limit order fills. Now we want the turn. And there it goes. Pushes up through the range, hits the 38.2 right here. Target reached. Trade closed in profit. Now, one last piece of operational advice that's not in the strategy itself, but will multiply your trades over time. Don't watch one stock. Watch 5. Every morning before the open, pull up 4 or 5 of the most liquid names you trade, your usual suspects. Mark the ATR on each of them. Write down the 25% threshold next to each ticker. Then, at 9:45, after the first candle closes on all of them, check which ones clear the liquidity threshold. Some mornings you might get 0 qualifying setups. Some mornings you'll get 3. For each one that qualifies, draw the Fibonacci, place the limit order, set a price alert on your phone, and walk away. Don't watch the charts. The setup either fills or it doesn't. The target either hits or the stop does, and you'll know from a notification on your phone an hour later. The reason most people fail at this strategy isn't the strategy. It's that they stare at one ticker, get bored when nothing happens, and either close the trade early or revenge trade something else to fill the time. The fix is to multiply your setups, automate your alerts, and disappear from the screen until 11 a.m. And that's the complete recap. Wait for the 15-minute candle to close, filter it through the ATR, place the limit order at the edge of the range, target at the first Fibonacci level, stop at half that distance. 3 out of 4 times, the market will do exactly what you want it to do. Thanks for watching, and I'll see you guys next time.